Jonathan Camarda as we roll through into September at the end of this week. So where do we start? Well, let's start in Jackson Hole. Less dramatic than last year. Certainly many are thankful, including this guy, as Jerry took it from up here to right about down here. Did mention, obviously, inflation's come down, but still a lot of work to do, where we heard this one before and such. Very interesting, as the market's pretty much, I think we're looking for a little bit more hawkish, although many have claimed he was hawkish, saying that they will raise rates again if they see the reason to do so. Probabilities right now, at least, are probably nothing in September, and then in November that you may see the next hike, and maybe the signaling that that is the last hike. Now, they won't go that far at this point. Still signaling that looks better than it did last year, but the road is still not complete. So, with that being said, markets, let's look across the board. Markets responded pretty well. I think a lot was factored in advance, maybe more hawkishness, like we said, and August has already been a pretty rough month. However, that being said, the S&P still, for 129 consecutive days, trading days, has not dropped more than 2% in a day, longest streak going back 5 years, for whatever that's worth. It's been a nice, obviously, year from that standpoint, consistency on not having that one-day volatility. So as we look across the macro regime here, if you look at the Fed and where the U.S. is versus the ECB, Lagarde there over in Europe, a lot more work still to be done there if you look at their CPI data and such. So probability is about 40% for the ECB to hike. And obviously in September, they're meeting and not for the Fed. So what does this mean and how do I look at that? I'm looking at from a currency standpoint like we discussed, right? So as the dollar this year, slightly up against the euro, down versus the yen, but also against the Canadian dollar. What does this mean? Well, the dollar has been on a little bit, obviously of a streak here, recently. Very interesting here because if the ECB raises and the Fed doesn't, that would generally be stronger for the euro versus the dollar. What does that mean for you? Well, again, that could be another soft patch, again, for especially those large cap multinational companies that export a lot of their goods. Again, a weaker dollar would help from that standpoint. But still, there are uncertainties with that. Again, as I personally look at that euro dollar chart and how that trickles down from monetary policy and such trickles down to currency valuations and changes, and then, of course, trickling down to what you folks care about, the equity fixed income, to a lesser extent, alternative markets. Now, as we now move past that, so how does the investors out there from the retail to the professional institutional money managers? So when we looked at the AAII, the American Association of Individual Investors, actually for the first time about 12 weeks, bears are outnumbering bulls. Well, no big surprise there with an August pullback. That sometimes can be a contrarian indicator that we look at as, again, the bears have now taken over the bus from the bulls slightly, so we'll watch that. Now, what I also look at is what we call the NAME, National Association of Active Investment Managers, professional institutional money managers out there that are active, they're not passive. In other words, what we do, right, more active, where we're assessing the landscape and not just holding a set, what they call strategic asset allocation, just hoping for those long-term, trends to hold through. Now that worked out well. Less information, less AI, less machine learning, speed, of markets and correlations that go to one, which means when the peanut butter hits the fan, it hits everyone. Diversification is not your friend in that situation. So for passive investors, generally rebalancing and keeping that set mix, which last year, not such a good idea, right? As we saw bonds come down very hard, which is why we had, again, early last year, reduced that exposure. So that's what we call active, actually looking outside the windshield and maybe making adjustments to change a lane if it makes sense. So that association, though, for the first time with a pretty brutal August. I shouldn't say brutal. I mean, it's been a good year, right? It's been a pullback, okay, depending on how you're invested. But essentially, that their equity exposure, risk assets exposure has dropped from 100% in July, as that bus was full, to less than 40%. Now, I sometimes will look at that as a contrary indicator as well, even though they are professionals. Again, as we have hedged up a little bit in some of your strategies going into what has been a pretty cruel September the last few years. However, again, since August was pretty rough, we have to see if those Septembers continue to hold through. And going in with a slightly hawkish Fed, but not over the edge like last year, we'll see. Now, that being said, the reason why we are starting to pull out the defensive playbook, dust it off a little bit, is because when we look technically, right, at the charts, The 50-day moving average, which was a line of support, this trend up this year, has now become a line of resistance. What that means is that once the markets are trending up, for example, the 50-day is almost look at it as a paved bridge. Once that bridge cracks through, the market seeps through, and imagine that bridge reseals like some science fiction movie, and then you try to ascend and it becomes a ceiling, like some Indiana Jones movie, Temple of Doom, etc., then that becomes an issue. So the NASDAQ, the S&P, and even the Dow Jones, which has underperformed this year, are all bumping into that ceiling. Now, right underneath that, I tend to look at the 100-day moving average as well, and that's not too far below. We've been in that zone, so that is acting as the current support. With the 200-day moving average, we're talking about long term, way down there. We don't want to retest that and certainly be extremely long in that situation or in risk assets. So kind of watching that corridor right now very carefully. What that all means is, we have our hand on the wheel and between the foot, between the brake and the gas pedal. Now, technologies, of course, the whole AI has outperformed year to date. That's news. You already know about that. We do tend to watch that. Now, what's interesting is people now have a choice, right? It's not the Tina market, right? Tina's no longer the prettiest girl on the block. There is no alternative, is what that stands for, to equities. That's been the past rallying cry. But now, as you folks see in your accounts, we've been taking advantage of this for months here. You can get high fours into low fives, not only in treasuries, but money markets. So now what is happening? People that are not invested in markets, right, are not putting their money in their local credit unions or banks, hurting some of these regional banks. It's a whole different issue for a different episode. But looking at money markets. So we're using that also as a hedge, as there is an alternative. Of course, nothing like equities when they were going up. So it's always that fine balance based upon your risk appetite. And clients, we've had those conversations. However, that is putting obviously a strain on your regional and local banks who are not getting those deposits. CDs, almost gone the way of the musical CDs. Still old enough like myself that you play those somewhere? No, not even I play them. Who am I kidding? But CDs not getting a lot of demand when you have money markets and such. So very interesting, just where money is flowing from that standpoint. As we roll into a Labor Day weekend, markets look like they're rebounding off of this oversold condition, but like I said, into some tight technical quarters. So we'll be definitely watching that. Not much news with the Fed now as we move into September. So there's a little running room either way. It'll be very interesting as we watch some of these macroeconomic things going on. So with that being said, again, if you feel like your risk is up here and you want it here or vice versa, based upon the environment beyond the models in your sleeves, talk to your personal wealth advisor about that and as such as well, as that specificity is very important. And again, we always tell people, based upon the nature of what your risk tolerance is, a lot of times good to adhere to that because you do have FOMO, fear of missing out. We try to tell people to be aware of FOM, F-O-L-M, fear of losing more, especially once you've accumulated a certain amount and you're not necessarily chasing the market on every light change because, again, you're already in good shape in that stage of your life. Off my soapbox for now until next time. We'll talk to you. Have a great Labor Day weekend. Enjoy friends, family, and the return of, real season football. Again, stay frosty, most importantly.